All right, welcome, folks, to the latest edition of Real Talk, where we put the real in real estate with our beloved Britt Fair. Hi, Britt.
Hi, Ashley. Thank you for having me.
Fantastic. Well, this is always one of my favorite conversations. As we chat offline, we're like, maybe we shouldn't talk about that, but we're going to talk about the gloom and the sunshine that could potentially be on the horizon for 2025 today.
That wasn't a political comment, was it?
It
I
was
see
not.
it in the teaser to this whole thing where we're supposed to talk election and who's gonna be awful and who's gonna be great, and
my bet's on. Yeah, absolutely. So I don't know. We'll see. I mean, there is absolutely a lot going on, and I'm so glad we were able to do this right on the heels of the Fed announcement, which I will tell you this in a very loving way. I did not realize there were so many consumers that were professional economists and were following the trail of the Fed announcement so much, but it has been very hyped up. I'm sure in your world, in the title business and your different markets of your offices and everything else, I've had investors, I've had tons of different people saying, I'm just going to stay put. Let's wait for the Fed announcement. And so what did that mean? It was 50 basis points. Isn't that exciting?
Well, I have a few thoughts. So number one, yes, a lot of people get confused. And so for any of those people, I'm sure none of the people that watch Real Talk are confused by this, but the Fed funds rate does not translate to what's going on with mortgage rates. And in fact, when the Fed announced that they're decreasing the Fed funds rate by 50 basis points, the long-term, 30-year mortgages went up a little bit as far as the interest rate on 30-year mortgages. So while the Fed controls the short end, the 30-day, 90-day lending, even up to 1 year or something is very dominant by what the Fed funds rate is. These long-term mortgages, the 10, 15, 30-year mortgages, are really driven by what the inflation expectations are going to be in the economy. And so it's totally driven by two different things. And the fact is that the 30-year mortgage has come down in recent months. We were in the high 7s and now we're in the low 6s. So we already came down on the long-term mortgage rates. But so anyway, that confusion hopefully is cleared up, that there is not a direct correlation between those. The Fed controls the short end, and all long-term rates are driven by really the bond market, and the bond market watches for inflation.
Well, and they'd already take measures. They were taking that into consideration, which is why
they forward looking, right? I mean, they sort of guessed which direction, they see that inflation is coming down. So the mortgage rates have come down.
We are actually, I think, the lowest we've been in about 18 months. So it still doesn't feel fantastic because we're, hindsight's 2020 and we're looking behind as to what rates were, 2.5 years ago. But to be at the lowest point in 18 months, I think is a good indicator. It was really interesting. I was listening to a couple of real estate media podcasts before we did this one, just trying to see the different chatter. And they said, we'll just still be interested to see activity tick up after, what that's going to look like, showings and so on and so forth. But I don't know as far as, contracts or, new contracts or anything else in your different offices. I mean, for me, I'll be honest. I mean, the last probably 45 days, I'm like, hello, is my phone cut off? Hello,
Yeah.
Do you want to call me? Do you want to sell a house?
It's been a slow summer. It's been a slow, and I think it goes back to, at this point now, it's a lot of people are just, they don't like the uncertainty of the election coming up. And so I think a lot of people they want the certainty, and they may have strong opinions about who they like and who they don't like, but come the day after the election, or 2 days or 3 days after the election, whenever we know who has won this election, and also what the composition of Congress is going to be, then at least some certainty creeps in. It may be certainty you don't like, but it's still certainty. And people tend to like to make decisions with certainty as opposed to uncertainty. And so I think that is sort of, at this point, as we get close to the election, or as we have gotten close to the election, I think that has kept a chill on the market that was already chilly to start with.
Yeah, and I'm all about chilly because I look really good in layers, but not when it comes to my wallet. Robin Price just said people are looking for excuses not to take action.
There's plenty of them. There's plenty of them. You know, you said something earlier. I want to go back to though, because I think this is an interesting topic, and that is the 50 basis point drop. Right? You're talking about the Fed funds rate, and I said, okay, on one hand, it really doesn't directly impact mortgages, but I thought what was really interesting about it is, you know, the conspiracy theorist in me wants to wonder.
Oh, hold on. Should I put my tinfoil on?
Yes,
I have some next to me. Got it.
I have a couple
Got it.
here.
Okay.
What freaked the Fed out? Like what did the Fed see that, you know, because
they were at 25.
Inflation's not, you know, like totally back to 2%. It's on the path, you know, they're toward their target. You know, stocks are at an all-time high on that date. Housing prices, while they're not still going up dramatically, they're not falling, you know, haven't fallen to this point.
Right.
Or at least not nationally. So, you know, I think at least the theory out there is something spooked the Fed into dropping rates by 50 basis points. And so that's an interesting rabbit hole that we don't have to go down, other than to say that I'm wondering if the economy, that, you know, the jobs market and stuff is maybe weaker than what people were thinking a month ago or 6 months ago. And maybe the Fed is seeing something on that front. That's kind of where I'm placing my bets, is that the overall economy is weakening, and that's what the Fed is concerned about. Well, I mean, that's kind of what they said, was the job market was kind of their new concern.
Okay, well, that'll keep me warm at night.
Well,
you know, there's a rabbit hole. I got more rabbit holes to go down at this point, Britt. I'll have Sherry Walker help me with it.
I'm distracting over here. Look, there's something to worry about over here, so you don't pay attention to the election. See, look, I'm helping you.
No, I appreciate it dramatically. And, you know, Robin said, again, you have to have a place to live regardless of who wins the election. And I think that's obviously the truth. And, you know, I keep on saying this. We talk about the peak of COVID, you know, and the COVID market. But in all reality, we did not, I mean, like the real craziness of the market, I can look back and it was almost after the inauguration in January, in 21. Yeah. And so like it was starting to get like, you know, okay, things are heating up and everything else, but gangbusters, which we all know was 21, you know, and everything else. So to your point, I do think there was a level of, okay, cool. The other shoe dropped. We didn't know what shoe it was going to be, but it's dropped. It's on the ground, and we need somewhere to live. We don't want to rent. Rents are going up at the same pace that housing prices are. And so let's go.
I definitely think that factors in every 4 years. I think the 21, obviously, there was all the stimmy checks and all the PPP loans and all the craziness that, you know, the money printing that has, you know, the where people just and zero interest rate policy, you know, so there was a lot of interesting, you know, even the whole work from home for everybody's safety. Sure. So people were buying second houses and lake houses and homes, you know, and they have a job in New York City, but living here in North Texas or so, you know, so I think there was a lot of extra craziness in 21 that hopefully is working its way through the system to where we can get back to some sense of normalcy. But you're right. I mean, I think that election, and that one also took a few extra days and maybe even an extra month as it relates to the Senate runoffs that happened. But yeah, no, I think once certainty happened, I mean, people, you know, like I said, the fuse was lit.
Oh, well, Sherry's fuse has already been lit, and she said, you call yourself a conspiracy theorist, your rabbit holes aren't nearly deep enough, Britt. So
well, I've been taught to hide my crazy, and so I don't talk too much. I just hit surface, Sherry. I hit surface level on my conspiracy theories. You and I can get together and compare the depth of said theories.
That would be great. Let's do that offline. As I tell Sherry sometimes, like, you told me to hide my crazy as a child, and now yours is coming out, you know, as I'm an adult. But I think that's how the pendulum swings the other way. So
yeah.
Well, let's talk about inflation, because that obviously has name of the time.
Okay.
We'll get you offline, Sherry. But inflation obviously does have a large impact on everything that we're doing. And so you mentioned that we're not quite down to that 2% level that we would call under control. So what does that look like? Because I think a lot of people would argue they still don't feel like we're getting that under control. But how does the the government or the Fed actually dictate we're getting that a little clamped down?
I think the important thing to think about when you think about inflation is, we look at this number and say, okay, 2.8%, 2.9%, whatever it is today. I think the core was slightly over 3 core inflation, 3.2, I think. But the key is that number really doesn't, that's what the Fed talks about. But like what you and I and everybody on the street cares about is the cumulative impact of inflation, right?
Correct.
Because, we've been above that target for so long that, prices are 20 to 25% higher than 3 to 4 years ago. So even if inflation comes down to 2%, well, that doesn't erase the 25% that has happened over the last 4 years. So, right. So I think that, and again, you can back to Sherry and conspiracy theorists. There are a lot of people who don't think that 20 to 25% number is even close to accurate, but it is what what
they tell us.
What they tell us, right? So anyway, but the point is that regardless of whether you believe the number, the cumulative nature of the number is what's important, and that's what we feel. So if something used to cost $1, it's now $1.25, or if something was $100, it's $125.
Sure.
And so the fact that it's now only going up 2 to 3% rather than 9.1% a year, it's still going up, and it's still adding to what it already went up over recent years. So
sure.
These problems, and again, a pandemic is hard to predict, but again, some of the reactions to the pandemic have exacerbated the inflation problem, and it's not something that you get over very quickly. People are struggling. I think that's going back to what is the Fed seeing. I think the Fed is concerned about the overall economy and Main Street and employers being able to keep people employed. And so I think that's why they've sort of said, I don't know if that's quite the mission accomplished banner being hung, but they've pivoted and they're less focused on inflation and certainly seem to be looking more at the job market weakness than they are, focusing straight at inflation.
So what does that mean in ways? Because unfortunately, when we talk about getting to a better real estate market and a healthier market, meaning really driving around interest rates, right? Getting those interest rates lower, that means that the general economy might not be as great. So people are going to have to feel pain to get those interest rate wins, correct?
Yeah. That's unfortunately, I think the reason I have a positive prediction, right? The positive prediction is that I think mortgage rates are going to come down in 2025. Okay. So yay. All right. Hooray. And that will, and also hooray, that will stimulate activity for home buyers.
Yes.
That people are having a hard time buying stuff now. But unfortunately, the reason that I feel that long-term, mortgage rates are going to be coming down, the 15 and 30-year mortgage rates are going to come down, is because the economy is going to continue slowing, right? Yeah. I think the economy is slowing down, and I think we're going to see some layoffs or, sort of increasing. I don't know if you saw Microsoft's announcement within the last week where they basically said, we're not going to allow anybody to work from home anymore. Everybody's coming to the office 5 days a week. And that was maybe partly about working from the office, but that's a layoff. Like that, they told people you could move away and work remotely.
Yeah. And now you got to come back.
Yeah. Now you got to move back to whatever the big city is that, and people are going to not do that. And so that's just their way of cutting jobs. And I think that there's just going to be a lot of this job cutting that happens. And that's part of a weakening economy. That's part of what I think spooked the Fed. And so I think just this general economic weakness, I'm not sure if it's going to be technically a recession, but I think it's weakness that we're going to see with increasing unemployment. That will brings down the inflation rate further, closer to the target. And if the inflation rate falls, that's going to be what brings down the mortgage rates. So bad news, good news. I think I'll think of it as, unfortunately, in real estate, that's a silver lining, because to the negativity in the economy is we in the real estate world have been in a recession basically for the last couple of years. And so that will be, we might be the first ones to come out of a recession with activity picking back up in 25.
Well, that would be fantastic, because I would love to stop coloring my hair as much, because the grays might be coming in more predominantly over the last 2 years.
Yeah.
But that's okay. But like Cody Fair said, Amazon is doing that starting in January. And that's that's obviously a very large company that has dictated that. And I think we are seeing that. I think we're also seeing that preemptive cutting costs, clamping down, let's try to control expenses, knowing that's what's on the horizon. And so I think that is going to be more predominant in the large companies and smaller companies going forward. But, we still have a ton of people moving here. So even those virtual and remote workers, while they moved here to North Texas, we still have a robust economy and tons of companies that have come here. So the jobs market, even if you did move here in a remote work position, is still amazing, which I think is still why we've seen, a higher demand than other areas of the country.
We've got a lot of things going for us here. And I know I have been accused of being a cheerleader for this Dallas Fort Worth, really the state of Texas, but just the central time zone, the transportation, the airport, no state income tax. I mean, all the Chamber of Commerce type reasons we still have going. And I think we're going to, again, I always point to the North Central Texas Council of Governments, who is basically the group that all the local municipalities rely on to project things, because we have to build roads and way in advance and build schools and water sources and all these kinds of things, and they're projecting just this continued crazy growth for the next, they don't project out past 30 years from now or so, but it's, to 2050, we're going to go from 9 million people to 13, 14 million people in North Texas. And so they're still going to be coming. And so we will be cushioned by that. I'd much rather be in that world than say, a place where everybody's trying to get out of. And I will not pick on California today, but I was thinking California. So,
yeah, exactly. So Robin wants to know what your prediction is, because she said Goldman mentioned rates going to 5.5 in 2025. Do you think that's what it's going to be, or do you think it's going to be lower?
If I knew what interest rates are going to be, I would not be doing this. I would be just betting it all in New York on the financial exchanges and stuff. But that sounds about right to me too. I mean, who am I to argue with Goldman? But I think they're going a little bit lower than they are today. I don't think that expecting them to get back in the 3 range or whatever it was for a couple of years there, I don't think that's reasonable at all. My real prediction here is that rates are going to go down because we're going to have a slowdown. And then the Fed is going to panic because we have a slowdown, right? I mean, that we used to have these cycles, right? But I think the Fed is trying to perfect the world where we will never have cycles again. So we're going to have a slowdown and rates will come down a little bit. But then I think, I don't know exactly how and what, but I think the Fed is going to get the printing presses going again. I mean, partly because regardless of who wins the presidency, neither candidate seems to be that interested in balancing a budget and reining in Congress. And so I expect that rates are going to end up, in the out years, maybe not in 25, but probably during this next administration, rates are going to pop back up again, because I think that between Congress and the president and the Fed, we're just going to keep printing money and monetizing the debt, and inflation is going to rear its ugly head again. And so that will bring rates back up. So,
thanks so much. Yeah, I appreciate it, Britt. That was a great way to put the cherry.
Okay, but how about this? Okay. I think that means that 2025 is going to be a fantastic time to buy a house, to lock in a rate that you can enjoy for the many years to come.
Well, I agree with you. So Deborah said, even with lower rates, people are still struggling. I'm seeing a growing market. Builders are offering a growing buyer's market. Builders are offering 20,000 in incentives, and builders are able to do buy down rates for a couple years. Sellers are still unwilling to drop their prices. My market is stale. We have listings moving, but just a little. Of course, this happens during election year as a rule, but it's been a difficult year. Britt, you obviously do not benefit from a stale market either, so
No.
you're feeling it. There's nobody that is not feeling this market at this juncture. And we talked about builders, on the pre-show, and they have a different advantage than others. But what do you think about that?
Well, so on the builders front, certainly builders have been hitting the Sunbelt states hard as far as putting product on the, building as fast as they can since the pandemic, because of all the demand. And so, anything, it's kind of interesting if you look at the markets with the softest prices, meaning prices aren't going up much or maybe are even falling some. And it's, for the most part, it's the states that were the most popular places to move to during the pandemic. So Texas among them, Tennessee, Florida.
Yeah.
So a lot of the states that a lot of people move to, that's also where builders were building fast, and, which makes sense. Builders want to build where people want to be. But so that's where the softest prices are, is because there is a ton of competition from these builders. And as you said, builders have certain advantages about buying down rates and doing, at least the deep pocketed builders do.
Sure.
And so that has made things very interesting. But in reality, I would say a year ago, in fact, we probably can rewind the tape from one of our previous talks, and I said something that, as it turns out, was not correct. It was a theory, and and I thought we had an inventory problem. I mean, I think we all thought we had an inventory. Oh, inventory is too tight, and once we have more inventory, we'll have more sales. Well, we have more inventory now, right? We have 4 months of inventory,
and the sales are the same.
Yeah. And sales are basically flat. In Dallas-Fort Worth, I think we're up to 28,000 homes on the market, and we're still stuck at seven-ish thousand sales per month. And so that gets you 4 months of inventory. The point is, inventory has gone up dramatically, but the number of purchases has not. And so that leads you to believe that it's actually the buyer side, not the seller side, not the number of listings, but it's the number of buyers that is important. And so why are buyers not buying? Well, we normally talk about two things and drop the subject. We talk about prices, and they're high still. And we talk about mortgage rates, and they've come down a little bit, but they're still higher than what people are comfortable with. But what people haven't been talking about enough are insurance and property taxes, and maybe even a fifth one, like HOAs, especially in like the condo market, where some of these catch-up payments to HOAs are stifling that market. But the point is, the property taxes and insurance have also made a huge hit to these monthly payments that people kind of were not expecting, but both of those things go up. When the values of the house goes up, well, it costs more to insure because it costs more to replace, and it costs more at the tax man, property taxes, because the value has gone up. And I think people don't think about those last two as much as we talk about the first two. And so all of those things work in conjunction to where, I think there are some buyers who want to buy, but they just can't make the numbers work. And so the only way it's going to work, and I can't remember who said it, but is if sellers do get desperate. That's where the sellers and buyers meet, is when some seller let's just say the job losses happen, right? Again, if my theory is correct that we have some additional job losses and the economy slows, well, that's a natural seller or a typical seller in an economic down cycle. Well, that person comes down on their price, and that meets the price where the buyer is, and a sale happens. Well, guess what? That becomes the market price, right?
It does. And we just need a few of those.
Yeah. So then all of a sudden it's are sellers willing to come down to that price, or are they wanting to just ride it out and stay where they are? But right now it seems to be proven that buyers cannot or will not pay what the market is. And so, I mean, what the sellers are wanting. And so something's got to break. And I don't think it's buyers this time, because I think the buyers are the point they can't afford it in many cases. And so I think it will be sellers whose prices come down to meet the market if they really want to sell.
Yeah, absolutely. I mean, you have Tony who said crazy insurance costs are killing buyers, especially first-time home buyers. And that's something that I've been huge on, because I'm selling my grandmother's house right now because she was victim of that crazy windstorm that happened in June, and her chimney blew off the top of her house. And so, I mean, like literally no chimney, sitting there in Plano. And so going through the process, not even realizing, she had a 2% deductible on renewal, because obviously 1% is bye-bye, and she's older. And so going through all of those things, and it's been such a horrible process. I'm not going to name the company that was horrible to work with, and then it took 80 days and the adjuster wouldn't get on the roof ever in the multiple times they were out there. And so she had to cash pay a new roof and a new chimney. And we decided we're going to move her closer to us, which might or might not be a good idea, but we'll figure that out later, Britt. But going through all of that, and I really think insurance is a huge piece to what's going on with that sensitivity with home buyers right now. So I don't know. I mean, we've got that. Insurance premiums are going up 40% year over year. I mean, that's exponential. Taxes, at least the taxable rates, have gone down. So
they come down a little bit, but nobody's paying less in taxes.
Nobody's paying less in taxes, but at least the rates are coming down to offset the appreciation growth. But Deborah said salaries are not going up, with everything else going up. So it is simple math. And even though, real estate is the best way to build wealth, buyers are struggling. And Cody Ferris said again, he agreed with Deborah. Most sellers still haven't gotten the memo, that we're in a more balanced market. So I like how you said that, Cody. It's a balanced market. I often say this is a market of opportunity. For everybody.
Again, we got used to it a little bit, of it being a seller's market, right? And that almost, sort of like zero interest rates, or whatever, 3% mortgages people started thinking that was normal. That was never normal. Well,
no, it wasn't.
Having to make an offer on the first day is also not normal. And we kind of seemed to think that was normal for a while. So yes, we've moved back to where sellers cannot be ridiculous in their requests. They're not going to get it if they're ridiculous, or at least in most cases. And again, it's going to be, salaries are going up a little bit, but the point is correct that they're not going up as fast as the cost of living and cost of housing has gone up. And so, that's the point is, in the past, I think buyers, it was that marginal buyer who would step up to make the purchase and say, okay, I'll pay 50,000 over asking, or whatever the number was. Right. And right now what I'm seeing is, it's the other way. It's the sellers who are having to come down to the buyers in order to get to a number that the buyer can afford, because I think most of the buyers that, are wanting to buy that have not bought, that there are reasons they haven't bought. They can't buy because they just don't qualify. They don't meet, and especially, like I said, when you throw in all these, the taxes and insurance and HOA fees in the case of condos, which are also just skyrocketing. So I think all that stuff is, it's really put the pressure on buyers. And so sellers have to decide, do they want to sell or do they not want to sell? And so that's where we are, is that, buyers are tapped out. And, for a while there, they were able to go to credit cards or use their stimmy checks and all the stuff that we, the PPP loans and all the stuff that we went through. But most buyers have kind of burned through that. And, I'm seeing I saw some stories in the last couple of days about, companies like 401k companies, just anecdotally saying, like, you wouldn't believe the amounts that people are borrowing against 401ks that they've never seen before, and it's like, okay, well, this is something new. And, the credit card balances are higher than they've ever been before.
Yes,
and
they have.
Auto loan defaults are, so people are struggling, and it's not, like I said, and again, this is not to be a political comment, but like, it's not being made up either, that there are people on Main Street are struggling. Not everybody, but a lot of people are. But you get a juxtaposition because, then the stock market is at all-time highs, and so clearly some people are not struggling, right? I mean, Elon Musk is not struggling. Mark Cuban is not, whatever. I mean, name your rich guy. Things are pretty good for a lot of people. So
my rich guy is not Reese Gentry, which is my husband. So I'm feeling it too. But we've had really good dialogue going on in the chat over here. And the big thing that I want to touch on, but I love that our guests are engaging with each other, is Sherry Fearbacher. Not a popular opinion, but I think the media has confused the consumer with the settlement. Buyers don't know what is going to be required of them. And we talked about that a little bit in the pre-show, that we do think that the settlement and the forms changes and all of those things that have gone on in the media, misinformation and bylines have caused a little bit of friction at the same time in the summer marketplace. What do you think is contributing?
I think you're absolutely right. People are still confused, and frankly, we're all learning as we go, and the forms aren't perfect yet, and all that stuff. I mean, so agents are confused too, because there are certain, not everybody teaches the courses the same way, and frankly, the forms aren't 100% perfect anyway. And then you have on the consumer side, most people will maybe listen to input from their agent, but I mean, there's certainly some hotshot people who think, I know what I'm doing here, sort of a lot of the same FSBO crowd, but now they think, they're, I don't know, they feel more empowered than before.
Sure.
And so, they're going to tell you how it works, and I know my rights, and whatever. And so I think that also sort of puts a chill on the market of like, really, are we having to deal with this too? This is just too much. I don't want to deal with it. Uncertainty with the election. Okay, I'll punt to that too. That's another reason to punt until maybe there's more certainty in the election, and certainty as it relates to the forms and the procedures and all that. So I think you're right that doesn't help us, and it's probably put an extra chill on the market as well.
Yeah. And I think that's, what we talked about, I've got different listings and different price points and different marketplaces right now, and really trying to use each listing as a focus group. And it's not working because there's nothing that I can chart and say, oh, this makes sense. And this is what's going on. And I think Cody said it, way down when we were talking about his comment. The problem is that we also don't have sellers that are realizing we have a balanced market. If something needs updating, backs to a busy street, buyers are just fine continuing to look. And it's those qualitative conversations that I think are difficult. So now not only is the listing agent having to have a conversation about realistic pricing, condition of the home, even though you do love the fact that there's antiquities in here, and you love what you've done and all of these other things, but the new age buyer isn't necessarily going to appreciate those situations. And we need to talk about the fact that, offering cooperative compensation and what that looks like in this new procedural format. There's a lot of conversations that are having to be had on top of, I think, somebody else talked about the fact that we've got Michelle canceling homeowners insurance as well as not writing new policies. We have to have homeowners insurance conversations with the listing agent about the buyer potentially not even being able to get homeowners insurance, let alone having a potential homeowner having their policy not renewed, at some point. And so it's like all of these conversations that we didn't necessarily have, and it's all coming to us like a freight train all at once.
Well, it goes back to, you get in a way of doing things, and we got in a way of doing things starting in June of 2020, and that became the new normal. And the new normal was buyers were still able to get insurance. That wasn't a problem, but they were going to have to pay through the nose for whatever property, and they were going to have to do it on day one. right?
Yep.
And they'd have to pay cash or get really aggressive on financing and waive all appraisals or whatever it was.
Yeah.
And we felt that was normal. And more importantly, your buyers and sellers felt that was normal. And so it was never normal, but that was the way it was. And it was the way it was for a good couple of years. And, now here we are 4 years later, it's not that way anymore. And it's much more balanced. As you said, it's not swung, totally to the buyer side, but it's not what we were, which was a huge seller's market. And so sellers, again, they'll come to that realization when they are very serious about selling. And like I said, the way that usually works is somebody who has to sell because they need the money, and they need the money because they ran up their credit cards. They need the money because they got sick. They need the money because they lost their job, whatever it is. And that will redefine what the market is. And so to me, that's how this happens. That's how you get rid of the stalemate. A part of the way you get rid of the stalemate is at some point, either buyers blink or sellers blink. And my prediction is that sellers are going to be the ones that blink when they actually get serious about selling.
Well, and I think when you talk about so many people, maybe not so much as the buyers right now, but the sellers that are entering the market are transacting out of purpose, not out of just want. So it's need versus want. And to your point, they want to unlock the equity in their home because they've got debt, they've got other things they want to pay down, they want to take, an opportunity. It's downsizing. We've got a large, boomer generation that has not re-entered the marketplace yet, and we're starting to see a lot of downsizers. We saw that in the commentary, that there are a lot of our older clientele that are being priced out of their home, not because they can't afford the maintenance or anything else. It's because of taxes and insurance.
Yeah.
And so we've got job losses, we've got distress, we've got relocating, we've got people wanting to downsize, we've got people wanting to move near family. Those are all transactions of circumstances, though. And so when you talk about, it's not, hey, I want to sell and I want to get a pretty new home. It's, I need to sell because I have a life change. And life change is a different motivator. I just don't think we've seen enough of that to recalibrate the market.
No. But that's
your point and Cody's
that's
point.
what will come. That's what will come. And again, I'm not jumping up and down in excitement about it, and that because as I said, I think we're going to have more transactions in 25, which on one hand is positive, but I think we're going to have it because some people are going to have these realizations as sellers that I've got to sell my house, and usually that's because of something bad. And so, you don't want to jump up and down in excitement about that because there will be difficult times. And that's also part of the normal market cycle, right? We can't always be up and everybody's good forever and ever. Like that's not how markets work. And that's not how capitalism works. Like there has to be ups and downs, and sometimes there has to be a winner and sometimes there has to be a loser. And I think right now the transaction people are the losers because we're not having transactions, but I think we're going to have more transactions in 25. But I think that's going to come at the cost of a slowing economy and some job losses.
So it's like Robin read our minds in our pre-show conversation. She said, "This is depressing. Can we eventually talk about Forward Dallas?" I think City Council is meeting tomorrow, and I'm concerned about the long-term effects on that. And Robin, I appreciate that because Britt and I we're talking about municipalities, and their zoning and master planning and everything else, and that's also going to have an impact in our backyards. And while we don't need to get in the trenches on the Forward Dallas plan, what we do know is that is an overarching plan to create more density in the city of Dallas. And so I also told you, Britt, that Princeton announced it was putting a pause, I think a 4-month pause on I think it's like new home starts. I apologize if that's not the actual term, but they're basically going to say, hey, we need to pause for a second and make sure our infrastructure is going to support all this new construction on 380.
Yeah.
But we're going to see a lot more of that. So what does that look like? Because that obviously has a very hyper local impact to the North Texas market with these different municipalities and their zoning and permitting.
Well, first thing, again, if I'm just giving opinions, I don't like changing the rules of the game in the middle of the game. So, I don't like if people bought single family homes and then are being told by any government body that, oh, by the way, what you bought, we're now taking away from you and everybody can build a second house on their lot. Like I'm sort of opposed to that just conceptually.
Yeah,
but
sure.
But yeah, no, you're right on the infrastructure stuff. I mean, it is just amazing to me. Like these cities and the challenge, and again, I didn't know that about the city of Princeton, but just the challenge of infrastructure, matching the growth with the infrastructure. I mean, I look at, I don't live in Frisco, but I look at the growth in Frisco since 2000, right? So we're talking 25 years basically. And it was one high school back then. And for them to figure out how to balance, building up to, I don't even know how many schools it is, but it's certainly in double digits now as far as
I was about to say, I think I've got two hands.
Yeah. So it's more than that. And all the water and roads and stuff, and just, I don't know how you get there. And so when I hear if city of Princeton hasn't, quite caught up, like that seems to be much more normal than the sort of idyllic picture that I have of what Frisco did. I think every city is going to have that challenge of building infrastructure and then being ready for more citizens to come. And, you can't build all the infrastructure. I mean, I think of those like China. Remember when China built all those cities that were empty? They built it ready for people to come, and then they never came. So you can't do that.
No.
And so, that is such a balancing act. But as far as the density, I'm actually a fan of density. Like I love going down to Uptown and
sure.
My kids who are about to graduate college, like Uptown is the place that they really want to live if they come back to the Dallas area because of the density. But for me, I don't want any of it. Like I like going down there and getting away from it, after I have a meal or have a meeting or whatever. But the beauty is I think we can have both. I like places to have it. And then I like being able to retreat to a place because I don't want it, where I like to have a little more room. So.
No, I agree with you. And Robin, I don't know what the result will be tomorrow. I am abreast of the city council discussion, and our government affairs director, Matthew Church at Metrotex, is actually very involved in those discussions. We've done $1 million research analysis with Urban 3, which is a huge research group out of North Carolina that's helped us actually show Dallas and Dallas County what it looks like to create really smart density and increase taxable revenue with different projects, both commercial and urban development and different things like that. And so I'm like you, Britt. I'm pro density, but where it's tolerated.
Yeah.
And we have plenty of active space and everything else to do very curative plans, unused commercial developments, other things like that we could look at repurposing. So Robin, if you want to reach out to me directly, I would happily connect you with Matthew Church, and he will be at the city council meeting tomorrow to hear that further. But, those are the things that are kind of like off the wall, where we're sitting there and we're like, okay, we're looking at interest rates, we're looking at taxes, we're looking at insurance. And now it's like, oh gosh, now we got to look at city council. We got to look at these multi-use plans. We got to look at everything else that's going to impact a specific backyard. Man, it's a lot. So with 15 minutes left, we've covered a lot, and I appreciate that, Britt. You're always a good sport. What can we do to help dialogue with the consumer, though, both sellers and buyers, a little bit better, to kind of help them? Like, let's take down all of the uncontrollables, because there are a lot of things that we cannot control.
Sure.
But what can we do to still incite a little bit of positivity, even though we're gloom and doom sometimes even together? What can we do to still have those curative conversations with the consumer to tell them it's still a good time to buy, it's still a good time to sell? Because specifically in the North Texas and Texas market, we're doing better than most.
Yeah. Well, okay. For sellers, I think providing them the market information and explaining, what we're starting to see and how it's gone from a seller's market to something other than a seller's market, neutral
Sure.
now, and seem, we'll see if it trends to a buyer's market or not. But a lot of the asking prices are pie in the sky. And, and again, I know that's a difficult conversation because then they think you're just trying to make a sale. You're not trying to maximize the, so you're going to have that conversation. But that's the conversation you have to have is information to sellers that sure, you can list your house for up here and you probably won't get an offer, but again, you can do it and we can have a sign in the yard. But realistically, buyers are having a hard time affording. So, if you really want to sell, you're going to have to get more realistic on price, but that's up to you, Mr. or Mrs. Seller. On the buyer side, I think the reality is we need to counsel people to look at what they can afford. And again, our mortgage lender friends are really the best ones at that because, they're looking to their mortgage person going, what do you mean I can't afford a home that is going to consume 80% of my monthly income? Right. Yeah. It's so lenders are great at that conversation. And again, maybe you point to a lender and say, hey, get with this trusted lender and they'll work with you on what you can qualify for. And, you may not want to go for everything you can qualify for. Think about what's in your budget. So I think, that kind of counseling, but, I will say this as another thing to buyers, and really you could say this to sellers who are going to turn around and be buyers, but I think 2025 is going to be a really good buying opportunity. And I don't mean like we're going to have a price crash and therefore, we may have a price correction downward. I think we're going to have a little bit of a price correction downward. But I don't think it's a crash. But if I'm correct in, sort of what I'm seeing economically and sort of what the government's doing and the Fed is doing and how nobody is concerned about the budgets and the deficits and the entitlements and all that stuff. It's just like, we'll just print money.
Yeah, we'll just spend.
If we keep printing money, asset values are going to rise. So, in the long run. And so that's, in a nutshell, I think that's the direction we're heading is that you're going to want to own assets rather than rent.
Own more. Yes.
And so, a seller, maybe a seller, and again, if you're talking that's a 90-year-old, okay, well, they're not going to turn around and buy a house. And again, this inflation isn't probably going to kick in during their lifetime anyway, big inflation. But if you're talking to a 35-year-old, right, who's got probably a lot of runway ahead of them, I just think that owning a home, and again, if they're in a city that they want to live in and that they're and have good job prospects and all that, but I just think owning assets is going to be such a crucial factor versus renting assets. And again, you want to rent if you're not sure you're going to live in North Texas and you may move back to New York or whatever. Okay, rent. That's a perfect time to rent. But
sure,
I just think the way we're headed politically, neither candidate has any interest in balancing a budget. Neither candidate wants to talk about Social Security or Medicare or whatever. So that just means we're going to be whoever wins, we're going to be printing money for the next 4 years at least, and probably longer than that. And so you're going to want to own assets rather than buy. So find one you can afford now. The principal and interest and taxes and insurance and all that, and then so I think we're going to want to counsel people to be home. Find a place that you want to settle down and keep looking for the bargain, because there's going to be a seller who comes down and matches your price or what you can afford.
Yeah.
So that to me is the counsel for buyers, is that don't give up, but also don't spend more than you have to where you're going to get foreclosed upon in 2 years because you can't make the payments. So anyway, there's something for each party, but I think in the long run, back to, you said something earlier that, it's an old, that my house is the biggest asset I ever had. Or
yeah.
That's going to be more true in the future, just because, most people don't have an asset anywhere near the size of the value of their house. And so I think that you're going to want to be a homeowner because I just think the inflation problem is going to continue to get worse, and that it may be down in the twos now, but I think we should get used to inflation at rates that are higher than the twos in the out, so.
No, I agree. Everything you said was absolutely amazing. And I was about to say something about what Chastity Hilton had said about being a buyer and a buyer's agent herself. And then she chimed in and she said, "Are we really still telling buyers it's a good time to buy? My sphere is mostly millennials aged 30 to 35 with good paying jobs who are still struggling, an expectation of future interest rate cuts. It seems the dialogue would be more beneficial in making sure income, solidified debt is being paid down, credit is clear, etc." The thing, Chastity, that I was going to say to your point is, I think we need to be having different conversations with our younger buyers, which is that first house is probably not going to be the house that you want to buy at your first house. So whether it's your first home or you're going to buy a duplex. And right now the investor marketplace and the duplex and the quadplex marketplace, because of the commercial interest rates and everything else, is soft as well. And so if you can't cash flow something as a pure investment situation, that is a great time for a buyer to analyze, you know what? I'm going to sit here. I'm going to buy this duplex. I'm going to live on the other side. It's not ideally, there she goes. Bingo, Ashley. It's not ideally what I want to live in for a long period of time, but I'm going to live in that thing for 2 years. I'm going to have a renter on the other side. I'm going to help cash flow, the larger interest payment and everything else. And then ultimately, I have figured out how to gimmick in the game. And I think those are the conversations that we need to be having with the millennial buyers or the younger buyers is, hey, stop looking at the white picket fence and just get in the game, because if you can build equity into those assets, then those assets can trade up into the houses you really want.
I think Chastity's points are right on. I mean, the first thing I said about buyers is find out what they can afford. And I totally agree with you that, if you've got credit card debt, of $50,000 paying 25% plus interest rates, you're not in a position to buy a house. Like you need to take care of that before you really are, so. And then the other part of my comment was, I think 25 is the year that will be the good year. You said, are we saying right now is a good time to buy? No, I think that sellers aren't quite real. And I also don't think rates are quite down to where they're going to be. So my comment was, I think in 25 is going to be the buying opportunity, but now we can be counseling these people on what can you afford, maybe take, sort of the Dave Ramsey approach of I know. Sorry. But like, at least on the credit cards, I mean, the credit cards that you're paying 25% plus is just, that's financial suicide. And so you got to get that taken care of before you really should be worrying about buying a house. But buying a house, I think 25 is going to be a really good year if you've got your house in order and, are starting to figure out, the neighborhood you want to live in and all that, because I think that will be a really good year to buy given the inflation expectations that I see on the back half of this decade.
But I will tell you, I work with a lot of investors. And so I'm constantly looking at the new multifamily products that are going on the market every single day. I have auto alerts that are going on, and duplexes and quadplexes and things that a traditional first-time home buyer actually has, active access to. And I get it. It's not very centrally located to the Metroplex. But at the same time, if you can sit there and you can look at something in a little bit of a diversified way, I think that's the opportunity right now, especially if an investor is putting a multifamily product on the market. They need the cash. They need the capital. So from that standpoint, what Chastity is saying, I do think there's a buying opportunity in those 1 to 4 units that somebody from an investor standpoint is putting back on there because they need to liquidate that capital. So I think you just have to find those right opportunities, which might be few and far between, but they're out there. And I think that's what this challenging market in 2024 has kind of given us.
Right. But if the economy slows down further, as I project, like the general economy in the U.S. slows down further for the rest of the year and into 25, that will cause some people to really need to sell. So that will create buying opportunities, and that will also bring mortgage rates down. So you'll get the double positive of what I think is a softer economy, which creates a few hardships and sort of forced sellers, and it creates lower interest rates. So I think that, like I said, counseling the buyers now to be ready to take advantage. And I hate to use that because you really
but
are.
It's where we're at.
Somebody's going to win and somebody's going to lose, but
sure,
somebody's going to need to sell. And if you're ready to be a buyer at that point in time, it's going to be a good time.
So we've got Cody coming up with another great comment. And he said, and we've all seen the cost of waiting for a lower rate versus paying for the home. Even if rates come down another 50 basis points and prices go up only modestly, the buyer would have been better off jumping in now. And I think
that's if prices are going up.
that
which is not my projection. So
okay.
That has been true, and I the math checks out on that. But if the economy heads where I think it's heading, which is slowing down, then I think some of these sellers are going to be forced to sell, and that will cause some prices to soften. And so you will have, in my opinion, in 25, the double positive for a buyer of lower rates and slightly softer pricing.
So the other thing I will say to that is, and I agree with you, Cody, that we are in DFW versus the rest of the country. But I will also go back to your other comment. We also have to have market ready properties, and those sellers that are willing to get their properties market ready will benefit from the fact that interest rates will go down and prices will go up. But those that are not willing to sit there and reinvest into their asset to put it on the market, I think are still going to struggle, and we'll still see softer prices. So I think it's a double-edged sword, on both sides.
I think the people in Austin 2 years ago would have said, this is Austin. Our prices are never going to go down. And Austin prices are the weakest in the country, or at least they've come down 20% in 2 years. So,
but we're trying to keep Austin weird, Britt.
Well,
and so
they're doing a good job of that, maybe a different weird, but again, so I think the point is that, supply and demand imbalance, now people are maybe moving out of Austin that moved in or whatever it is.
Yeah.
But I think the point is that I just think these economic factors are going to hit some of these sellers, and reality is going to hit, August over August, year over year in North Texas, prices were flat, 0% change.
Yep.
And so it's not like they're rising as of right now. And so I think as the economy slows, it will go from 0% year over year to something, slightly negative. And so that plus the improvement in mortgage rates that I expect, like I said, that's why I think 25 will be good.
25 is going to be great. And I think sellers that are willing to reinvest into their properties are still going to win out. And like we talked about in the pre-show, we made one of my buyers made a full price offer on a completely renovated market ready property because we saw the value in the fact that they had done all the grunt work. And ultimately that's what we need to be talking to our sellers, is the fact that your property needs to be market ready. We need to reinvest in those assets, and we need to be doing those type of qualitative improvements. But ultimately, it's timing, it's dialogue, it's everything else.
Well, you got to be ready. That's the thing.
Yeah.
That my projection, and I'm just saying 25, like there's 12 months in 25. Could that be January? December? Yeah. But I'm hedging my bets a little bit there. But the reality is, with your buyer candidates, your likely buyers, like obviously we talked about getting their credit card situation in order or what, and figuring out what they can afford, getting with a lender, and also, starting to look at neighborhoods and things like that of where they would like to, when an opportunity arises. So that doesn't mean that they should be sitting on the sidelines and
nope.
not waiting. They shouldn't be waiting to 25. They should be active now so that they are ready to pull the trigger, whether it's January of 25 or June of 25. So anyway, I don't mean to imply that people should just sit back and not do anything. I think you need to be ready. And in some cases, like I said, get your house in order, and like I said, pre-qualify with a lender and find out who a reputable lender is. I mean, I think we all agree working by referral and knowing who's good and who gets the job done. And again, I'm not going to name names, but we all know who people are who do good jobs. And so, but I think that's what they need to be doing now, because opportunities are going to arise.
They always will. Align yourselves with great affiliate partners, guys, great title companies, great lenders, and make sure that you're having those amazing dialogues with your sphere of influence on why you should hire a professional. And this evening has been great, Britt. You have not been gloom and doom. I appreciate it greatly. You've done a great job.
It's a mixture.
No, it's been real, which is what we do here. So I appreciate it. We'll have you in Q1 of 2025.
Awesome. Well, thank you for having me, and thank everybody in the chat. Thank you for all the great comments. That was really good.